that. I'm just gonna keep it simple. And you're gonna say that they need, 10 years of protection to make sure that the family will be okay. So that's $500,000 of future income that will be lost to the family. Now, you, certain words that I'm saying as I'm going along, I'm stressing it because you're gonna need to remember that. So there's $500,000 of future income that would be lost to the family. Now, where is the $500,000 coming from? If a person already has $500,000, they are financially secure, they're self-insured, they don't need to purchase life insurance, all right? But the people that we're going to deal with, many of them have no money saved, and they need to have life insurance. So in this case, by purchasing life insurance, we're going to be transferring the risk. We're transferring that $500,000 future lost income over to the insurance company. And if death should occur, the insurance company will have paid to the survivors the $500,000. All right, everybody clear on where we're going right now? So basically, first and foremost, when you buy life insurance, that is called the transfer risk. So let's deal with the definition of risk, which is on page 6, number 1, risk management key terms. Terminology is important. So risk is the uncertainty or a chance of a loss occurring. Do you know your date of death? No. So it can happen at any time, correct? All right, so we're dealing with that uncertainty of dying. Now, there are 2 types of risks that you need to know a little bit about. You need to know pure risk, and you need to know speculative risk. To keep it simple, pure risk is the possibility of a loss only, no financial gain. So when it comes to purchasing insurance, all the insurance companies are looking at is making whole the family. Or you think about your automobile insurance. They're looking at if you have an accident, just making whole whatever the amount of damage is that has occurred on your automobile. So with life insurance, that's all they're looking at is replacing that income that they are earning at that particular time when you are applying. Not whether or not 10 years down the road, they'll be earning $100,000 a year, or 10 years down the road, we'll deal with that if you are still living, all right? So pure risk is insurable. Speculative risk is the possibility of a loss or a gain. That's like gambling. When you gamble, when you're betting on the lottery, when you're going to the racetracks, you're going to the casinos, you're going there with the anticipation of what? Hitting it big, or, or getting the right horse when they go across the line and making money from that aspect of it. But there's also a possibility that could happen. You don't hit the big number and you put all of that money into it. Your horse didn't come across the winning line, and so you lost all of that money. And so there is no insurance of any kind that you can purchase that is going to cover your gambling losses. So speculative risk is not insured. All right? Now let's move on. Let's talk about hazards. What's the definition of hazards? Conditions or situations that will increase the probability of a loss occurring. There are 3 types of hazards that you need to be familiar with: a physical hazard, a moral hazard, and a morale hazard. Let's talk about a physical hazard. We're talking about something that happens to you and your physical body. What could happen to your physical body if you've been smoking since the age of 16? Anybody?
Lung cancer.
Lung cancer, all right? A serious illness there. And understand what's going on with your physical body is most important to the insurance company, all right? Then we'll have a moral hazard. Moral hazard deals basically with your behavior, your attitudes and whatnot. We know the difference between right and wrong. Sometimes we can say our parents, your parents can say, I taught you better than this, you knew better than this. But we sometimes, when we have a loss and we have to put in a claim, we're gonna lie on the application. All right, now people will lie when they're just applying for insurance. They're there's no claim. They're gonna lie when they're just attempting to get insurance. Now, if they're putting in an applicant, putting in a claim, and they are lying on the application, then that means the insurance company may be paying out much more money than they are really entitled to. And when insurance companies are paying out more money that they really should be paying out, one of the things that can happen is they can start increasing the rates and charging us more premiums for our coverage. So we don't want people to lie, but people are going to lie, all right? And they're gonna lie on a life insurance application, and we're gonna be talking about that also. And then we'll have a morale hazard. And therefore, we're also dealing with our morals. We still know the difference between right and wrong, but we're going to also be a little reckless and a little careless and have an attitude of, as long as I have insurance, why should I worry if I have a loss? I can be reckless. I can, maybe you're the kind of person that says, I can drive while I put my makeup on, or I can text and drive. And we have no control of what's going on in front of us if our eyes are not on the road in front of us. And sometimes we can end up with a car stopping really quickly, and because you're texting, the next thing you know, you're in their rear end and now you're at fault. So we have those three types of hazards: a physical hazard, a moral hazard, and a morale hazard. Situations that increases the probability of a loss occurring. All right, now let's look at the next word, and the next word says peril. Do you think insurance companies would want to know what was the cause of the loss? When you have a car accident and you put in a claim, what was the cause of the accident? It's one of the first things after they check and make sure that you're okay, is what happened. What was the cause of the accident? And the same thing, the insurance companies also, they want to know what happened, what was the cause of a person's death. And so, of course, they definitely need the death certificate to see what they say was the cause of that individual's dying. And just depends upon the cause and the time will determine whether or not an insurance company is going to pay that death benefit. And we'll be talking about all of that. All right, so peril is the cause of a loss. All right, now, if they have a loss, you know that there's a reduction in value. If you had an automobile accident, your car is not worth what it was before the accident occurred. And then if your family is living on $50,000 a year in income and you don't make it back home, there's a reduction right there. Because why? That $50,000 income died when the breadwinner died. So we're looking at what? Purchasing insurance and transferring the risk over to the insurance company so they can make you whole. All right? Any questions up to this point? All right, let's continue on. And let's go to page 8. And there, you're going to see the word exposure. Now, do you have, where's the pen? Where's my, Nellie, do you have the pencils? We need another highlighter. If the highlighters are out, then throw them in the trash.
I need one.
All right. Well, because if you put them back in there, you got one up here. Do we have any more? No, any more
We only
highlighters?
have one,
We only, well, she,
but I have, I think.
you have some,
Okay.
all right. No. All right, but on your acronym Alice sheet, up here we have one. Nellie, this one up here.
You have one of them.
Yeah, thank you.
I think.
She's coming. We don't put this one here. All right.
Anybody?
On your acronym Alice sheet that you have received, we're gonna deal with your first acronym. And that acronym is AMOS, exposure. Unit of measure that the insurance companies are going to use to determine what the rates are that they're gonna charge the individual for their insurance. And we're gonna be looking at these 4 factors that the insurance companies use when they're looking at what the rates are going to be that they're charging this individual. AMOS, AMOS. The A stands for age, M stands for medical history, O stands for occupation, and S stands for sex. Now let's deal with age. The older we are, the more expensive insurance becomes, right? And then your medical history is very important. Insurance companies are looking at what is going on with our physical bodies to determine whether or not they feel that they want to take on that client as that applicant as a client of the company. O stands for occupation. There are hazardous occupations and there are non-hazardous occupations. And of course, the insurance companies are also focusing on your occupation. Is it hazardous? If it is too hazardous, they may have some issues with it, and we will be dealing with that also in another chapter. And then sex, the letter X, male, female. In the insurance industry, there are only 2 genders, male and female. All right, and that's all we need to know from that standpoint. Whatever they say they are is what they are. All right, and we'll leave that alone. All right. The next term, and you see a lot of bold print numbers of words or sentences. Make sure you are alert to those also. Homogeneous, a large number of units, a large number of people at different situations, different occupations, different ages, different medical histories, medical reasons. They're looking at all of that, and that's called homogeneous. All right, large numbers of units. All right, and again, the 4 factors of the 4 basic features that the insurance companies are looking at to determine what our rates are going to be. AMOS, AMOS. All right. Okay, now, insurance companies, they market and sell their life insurance products to applicants for insurance, but they sell them through us as producers. We are the company's first line, and we're known as field underwriters. And we'll talk about our responsibilities in a short while also. But again, we're the ones that's actually sitting and seeing our clients, and we're the ones that's asking the questions on the application. So we have a lot of responsibility as field underwriters, which we'll deal with. All right, but now we're going to focus on number 2, the methods of handling risk. How does an insurance company deal with those methods of handling risk? And we have another acronym which will be on your second page. And this acronym is called STAR, STARR. How do you go about handling that uncertainty? Since it's talking about the methods of handling risk, the methods of handling what if, your health situation, or if you should die. We're going to start with the letter S. It's STARR. S stands for sharing, the T stands for transfer, A avoidance, 1R reduction, and the last R retention. All right, now S is basically sharing. So think about a situation where, first and foremost, when individuals die, the first thing family members are looking at is insurance. Is there an insurance policy? But if there's no insurance policy, then they want to find out if they have any money to bury them. All right, now that they found out there's no insurance, there's no money, then what are they going to do as a family to bury their loved ones? And back in the olden days, what did they do? We would pass the hat and come up with the money. But now, what do people do? GoFundMe. And a lot of individuals, when you see GoFundMes, it's not only to take care of the family, but it's also because oftentimes there may be no insurances to bury the individual or individuals that has passed away, and they are now GoFundMe. And so therefore, those individuals are sharing. And you'll also have your homeowners associations, your condo associations. Everybody is putting money into it, And so they are also sharing. Now let's deal with the letter T, which we don't really want to do the sharing, so we really want to do the T and transfer that risk over to the insurance company and purchase life insurance. But how is an insurance company able to pay out all of that money? How are they able to do it? Here's this individual that is getting a life insurance policy with a death benefit of $500,000. Now let's say they're gonna be paying $300 a month in premium for that. And the individual insured does die. Where is $500,000 coming from? How is the insurance companies able to come up with $500,000? Do you think that that policy owner is gonna pay in $500,000 in premium? No. So in this case, large numbers of what? Policyholders. All right, large numbers of policyholders. And what do they do with the money when we pay our life insurance premiums? Do they just put it in a bank account, let it sit there? What do they do with the money? They invest in that money. So they have to have many policyholders. Some paying small premiums, some paying jumbo premiums and whatnot. And they are investing that money. So that means we as policyholders, aren't we also sharing in the risk? If an individual dies and you have a policy and you're paying premiums because your money is also being invested to help cover those death claims. So we are also sharing when we are transferring the risk. All right? Now the letter A stands for avoidance. And if you see on the screen, the man's legs looks like he's running away. So when you are avoiding something, it means that you are staying away from something that could cause you some bodily harm, or something that could also cause you to have an accident or even kill yourself. All right, so avoidance. Some people will not get on it. And right now, they're a little afraid of getting on an airplane. They were already afraid of getting on an airplane, but now they're a little bit more afraid of getting on an airplane because of the fear that that plane may not make it to its destination. All right, so we will drive, and then we may not even get on a boat because
that's it.
Well, let's say cruise ships instead of just a boat. But getting on cruise ships and whatnot, some individuals do have that fear of, wow, what if this cruise ship gets abandoned out there in the middle of the ocean? And you think of this show that's on the television now, and they're on a cruise ship, and now they're showing a commercial where all of these, Sharks have now circled out in the ocean, and now it's shut out all of their electricity, all of that, and they can't get away from the sharks out in the middle of the ocean. It's the idea, boy, if you saw something like that, and you were thinking about going on a cruise, you may decide, oops, no, I'm not going on that cruise because that could happen in real life. All right, so that fear, so we're going to avoid putting ourselves in situations where we might think we may not make it to our destination and get back home if we're on a cruise ship. All right, avoidance. 1R stands for reduction. Let's look at the young lady. Seems like she is what? Jogging, exercise. Our doctors are oftentimes telling us diet and exercise, our health is very important. And not only to ourselves, because we want to live a long life, but our health is also very important to the insurance company when they are making the decision about that applicant that you have submitted to the insurance company for coverage. All right, now that we've gone through all of that, let's deal with the last R, which stands for retention. And what do you see with the retention? You see a piggy bank. And when you think of a piggy bank, you think of what? Money. Saving. So now that means you need to do what? Save some money. And if you are saving the money, you may not what? Need the life insurance because you have become self-insured and retained all of the money that you need. Now, of course, we're going to talk about other types of situations, but again, you think of the concept that we have here at Primerica, which is, of course, to buy life insurance. I'm not going to say the time because we're dealing with that in a chapter, but we're going to buy life insurance, and then we want them to do what? To start saving so that at some point in time, there will be no need for life insurance because now they have saved and invested money and they are now financially secure. They have retained all of the monies that they need. Now, sometimes we may not be able to what? Save and become totally self-insured. But another way to think of retention is to think of your copays and your deductibles. You are retaining part of the loss by having co-payments and having deductibles, especially like on your automobile insurance and your health insurance. And more that we are willing to pay out of our pocket, which means that insurance company is going to charge us a lot less in premium if we're able to retain more of the loss up front. All right?
Yeah.
So the acronym STAR. Methods of handling risk. All right? Now let's move on to page 9 if you're not already there. We're going to talk about number 3, which is the elements of insurable risk. Do you think everybody that applies for life insurance is insurable? Do you think so? So some people do think that just because you're an insurance company, you're supposed to insure me because I need some insurance, all right? But not all risks are insurable. The insurance companies are only going to insure pure risk. But we're going to look at some of the reasons and insurable reasons, risk reasons why insurance companies are going to look at you. We're going to look at some basic characteristics of insurable risk. The first one is due to chance. A loss that is outside of the insurer's control, something that is accidental or unintentional. So they definitely, especially with automobile insurance, was it an accident or was it intentional? And when it comes to dying, sometimes was it an accidental death or was it an intentional death? And we'll be looking at that also. Definite and measurable. A loss that is specific as to cause, time, place, and amount. Insurance companies are looking at basically how much risk they're willing to accept. So therefore, when you have a life insurance policy and it has a death benefit, the one thing that the insurance company knows is going to be the amount that they will pay out if death should occur. But we don't know what. We don't know the date, we don't know the time, we don't know the place, we don't know how. But if it happens, the insurance company, and if they receive a claim, the insurance company will know what the amount will be that they will pay out. Statistically predictable, they must be able to estimate the average frequency and severity of future loss exposures and make insurance charges. There are 2 tables that you need to be familiar with: mortality table and the morbidity table. Mortality table deals with our life. How many people are living or how many people have died at specific ages. Morbidity tables deals with our health. And as we know, as we get older in all situations, as we get older, when it comes to health, from a statistical standpoint, we start having more health problems as we become older. And so in that case, as we get older with life insurance and our health is beginning to deteriorate a lot more, the insurance companies are a little leery on who they will and who they will not accept as we get older. And of course, as we get older with our health, from a standpoint of health insurance, we start ending up having a lot of health problems and having to put in a lot of health insurance claims and whatnot. And they have limits. And of course, if you max out that limit, then we are on our own from the standpoint of what else is going to occur from that standpoint. We're going to get a nice big bill in the mail. Not catastrophic. Insurance companies need to be reasonably certain their losses will not exceed specific limits. And that is why policies will exclude coverages for losses caused by war and nuclear events. We don't have any stats on how many people would have died as a result of war or a nuclear attack, So therefore, since there are no statistics, the insurance companies are saying, if it should happen and we are dying, we are not paying death claims. So exclusions are things that the insurance company is not going to pay a claim if death should occur as a result of that. Yes, ma'am.
So I have a question. So say for instance, my son is in the Air Force and he just so happens to have an accident. Insurance wouldn't cover him?
I'm not gonna talk about that just yet because we're gonna talk about
Okay.
that.
Okay.
We're gonna talk about that. And you can bring that up at that time, but we are going to talk about the war. All right? So understand, you can ask a question. If it's something that's gonna be answered in another chapter, we're gonna back off on answering at this particular point in time. But basically, every question that you wanna ask, we're gonna have an answer for you somewhere in this material. But don't hesitate to ask, all right, just so that you know that it is a good question. All right? Now, my next question to you is, you are a producer, you're licensed, you're an agent, you have clients. And let's say, for instance, you have a person that you've been trying to get insurance on for many, many, many years. And now they come to you and they say to you, I need some life insurance. What do you think may have happened that caused them to come and say to you, I need some life insurance now? Yes, ma'am. A health scare. All right?
Someone paying.
Someone paid. All right, so basically those two are the most important. But the main one that we're gonna focus on though right now is medical. Should you wait until you have a medical problem to contact an insurance company to buy insurance?
No.
No. We're gonna deal with number 4, this term called adverse selection. All right? Insurance companies try to protect themselves from adverse selection, the insuring of risks that are more prone to losses than the average risk. Poor risks tend to seek insurance or pay or keep their policies in force more frequently than good risks. So therefore, to protect themselves from adverse selection, insurance companies have the option of refusing to issue a policy or even restricting how much premium they're going to be charging for that coverage. Adverse selection. So I keep it simple, and I say with adverse selection, the sicker you are, the more you want to buy life insurance, the less the insurance companies want you. Now understand, we are going to be dealing with this term a lot, or this basic concept a lot, but we're focusing on at the time of application. We're focusing on at the time of application. So if a person applies come to you and they purchase life insurance or they submit an application for life insurance and the insurance company issues a policy, and let's say they've been having some pains, but they hadn't been to the doctor just yet, and the insurance company issues the policy, and then they go to the doctor and the doctor gives them the bad news, is that gonna cause a problem now with the insurance company?
It depends. Sometimes it depends.
It depends sometimes, but the issue is, they didn't know it
Right.
at the time of application. So is that situation gonna be a problem? No, not that situation. If they didn't know it at the time of application, that situation is not gonna cause a problem. Now, if they knew it, that's another deal, all right?
You approve that it is the fact that the doctor told them to have to believe that they said, so.
That's all, we will deal with all of that also. We're gonna go a little deeper in that also, all right, from that standpoint. Okay, and especially focusing on terminology. That's one of the reasons I'm gonna back off a little bit. All right, so we're gonna focus a lot on terminology. All right, so adverse selection. The sicker you are, the more you want to buy life insurance, the less the insurance companies want you. Now, we've already talked about large numbers, so everybody understands the law of large numbers, so I'm gonna skip that. We're gonna go over to letter B. And now we're gonna talk about insurance companies, insurers. An insurer is any person or company engaging in the principal, as the principal party in the business of entering into insurance contracts. Insurance is available from both private companies and the government. The major difference between the private and the government is that the government programs are funded by our taxes, and our life insurances are from our premiums. Insurance companies, and we're gonna focus on private insurance companies, all right? Private insurance companies, you may also see the word private insurance carriers. All right, we're gonna focus on them and how they are classified. We're gonna be looking at ownership, the authority to transact business of insurance, the location of domicile, marketing, distribution system, and the rating and financial strength. And as it tells you, keep in mind that these categories are not mutually exclusive, and the same company can be described based on where it is located and how it is allowed to do the business of insurance. Now, the first two that you see here on the screen when it comes to ownership are the two most important ones that you need to know. All right, ownership. We're talking about insurance companies and who owns them. All right. The first one that we're looking at is stock companies. What is most important that you see here with stock companies? And this is what I'm gonna tap into, what is most important. Stock companies are owned by the stockholders. Go down to the next line, and who share in any profits or losses. And then go to that last sentence in that first paragraph. Stock companies issue non-participating policies. You must know what non-participating policies mean, which means that policyholders do not share in the profits or losses. Now again, stock companies are owned by stockholders, and the stockholders share in the profits and losses. Stock companies sell life insurance. Life insurance policies are sold non-participating life insurance policies, which means that the policyholders of a stock company, they just pay the premiums and have ownership of their premium, but they are not owners of the company. And so therefore, we're not sharing in the profits and losses. But we're now going to deal with dividends. All right, that's another term that you need to know. We're going to see it again. Dividends are profits, and profits are going to be shared with the owners of the company, all right? So when it comes to a stock company, dividends are never guaranteed, but the dividends are going to be paid to the stockholders. And the stockholders are receiving taxable dividends. All right, now I'm saying taxes, it may not be there, but I need you to remember. Stockholders, we are going to have to pay taxes on their dividends. So stock companies, they pay taxable dividends to their stockholders, and they issue non-participating life insurance policies. The next company is the mutual insurance company, which is on page 11. Mutual insurance companies are owned by policyholders, all right? So again, owners of the companies are the ones that are going to be sharing in the profits and losses of the company. If you are a policyholder of a mutual insurance company, then you are an owner of that company, and you are sharing in the profits and losses. So therefore, mutual companies, they issue participating policies. Participating means that the policyholders do participate in the profits and losses of the company. But policyholders, whether it's a stock company or a mutual insurance company, what do we pay? for our insurances? What is that one word that we pay?
Premium.
We pay premium. Now, when it comes to a policyholder of a mutual insurance company, let's look at a stock company has stockholders. They're investing in the company by purchasing stock. And then the company also has policyholders. And they're paying premiums and premiums that the company can invest. Now, mutual insurance companies do not have stockholders. They only have policyholders. So in order for them to be competitive, to be able to stay in business, they're going to charge their policyholders more money for their life insurance. They're going to charge them, say if the premium should be $1,000, but because you're purchasing the policy from a mutual insurance company, the premium is going to be $1,500 because they need that extra money to help cover any losses. But if they made money and they are profitable, they're going to again share the profits with the policyholders in the form of dividends. So they're going to get dividends if you are a policyholder of a mutual insurance company. But what are your dividends? Your overpaid premium. They are returning back to you, policyholder, some of that $500 that you overpaid back to you. Now, of course, you don't know that as a policyholder. You really believe that you are getting the dividend check in the mail, or whichever way, because we're going to talk about those dividends from mutual insurance companies. Yes, ma'am.
So is that like a refund?
It's like that's like a refund. It's like a refund. And if it's a refund and they're calling it a dividend, are you gonna pay taxes on that money? No. So policy dividends, and I say that word, policy dividends are not taxable. But stock dividends are taxable. All right? Now you're gonna have to remember that about mutual insurance companies, because and no matter what, dividends are never guaranteed. All right, mutual assessment insurers, you're not gonna get an actual question on them, but you can have them as an answer. But what do they do? Mutual assessment insurers, basically, they cover big farm properties and equipment. All right, the big farmers, they need coverage. They need coverage on those big property, on that property that they have, and they definitely need insurance on that big equipment that they have. So that's what mutual assessment insurance companies do. So if you saw that as an answer, you can say, all right, I know it's not that one because they deal with farm equipment. Fraternal associations, definitely yes. You will have a question on them. A fraternal benefit society is an organization which has members and lodges, religious organizations, your fraternal organizations. They are able to provide insurance to its members. So in that case, fraternal, just think of, clubs. I'm a member of the club. I'm a member of the fraternity. I'm a member of the professional association, the teachers association. Are you required to be a member? No. But if you are a member and you enroll in the program, then you are covered under their insurance. All right? Risk purchasing groups, you're not going to get a test question on them, but you can definitely, again, have them as an answer. And the reason you're not going to get a test question, it says, is an entity. Entity means business. Is a business which offers insurance to groups of similar businesses with similar exposure to the risk. Doesn't even tell you what kind of insurance, but it is. Risk purchasing groups, liability insurance. So that's what risk purchasing groups are doing. They're providing liability insurances to businesses. All right? So you have, but know your three most important ones. Your stock companies, your mutual companies, and your fraternal organization. Now, which one is Primerica? Where do we fall?
Oh,
Which one are we? We're mutual. Anybody else? No. Primerica is a stock company. Primerica is owned by stockholders, and therefore, we are issued non-participating life insurance policies. So when you see a Primerica policy on the cover, you will see a stock company non-participating policy. So that lets our policyholders know we're not getting any dividends. Now, mutual insurance companies, think of Mutual of Omaha, Liberty Mutual, Northwestern Mutual. You see, most of them have the name Mutual in their name. So that lets you know those are mutual insurance companies, and they are owned by their policy holders. And the policy holders are paying a higher premium for their life insurance, but know that they don't know that they're paying a higher premium. And when they get a dividend check, they really think they're getting a real dividend check, all right? But all they're getting is what are they getting? If a refund of what? An overpaid premium. All right. Okay, let's go to page 12 and let's deal with authorized versus non-authorized insurance companies. Every life insurance company must be authorized or admitted to sell insurance here in the state of Maryland. And if they are going to be issued a certificate of authority. Insurance companies, in order to sell insurance in the state, they must receive a certificate of authority from the Department of Insurance after the insurance company has gone through the state's qualification process. So just because an insurance company says, I want to sell insurance in your state, doesn't mean that they're just gonna give you a certificate of authority. The insurance company has to meet that state's qualifications, all right? So Primerica has a certificate of authority to sell insurance here in the state of Maryland. And they had to go through a qualification process for the state of Maryland to say, okay, yes. And of course, Primerica, the state of Maryland has authorized Primerica to do its own pre-licensing. So if we weren't certified, we would not be able to do our own in-house pre-licensing. The state of Maryland has approved us to do that also. All right? Now, if an insurance company does not have a certificate of authority to sell insurance, then they are considered a non-admitted, non-authorized insurance company. That means they cannot sell insurance in the state of Maryland. Now, the very last sentence that you see under there, it says most states have laws that prohibit unauthorized insurers from conducting business in the state except through licensed excess and surplus lines brokers. All right, let's think of Lloyd's of London. Lloyd's of London. They insure things that regular insurance companies are not going to insure. And so, back in the day, Tina Turner, when she was alive and very popular, and her legs were very popular, and she was advertising for Haynes Insurance, and her legs were insured. They had hands advertising Palmolive, what dishwashing liquids, and that,